Hello all. Today we will discuss about intercorporate deposits, various rules and regulations governing it, provisions of Section 186 of Companies Act 2013, and what are the key aspects or areas while seeing the ICDs in the balance sheet, be it in the form of a financial liability or a financial asset. So let's begin. So we will be covering ICD, which is more of a money market instrument, colloquially referred to as a money market instrument because it's catered to the short-term needs. What are the key aspects, provisions of Section 186, and the overall analysis about the ICD as a instrument of liquidity management. So let's begin with the ICD market first. An ICD is an unsecured loan extended by one corporate to another corporate entity. It's an intercorporate deposit. So when one corporate gives fund to another corporate, say for the liquidity mismatches are there or some short-term funds requirements are there, then that particular arrangement is known as intercorporate deposit arrangement. It's a mechanism for companies with excess cash to lend to other companies that require funds for a shorter period of time. One thing you need to note here that for short term need only it is to be garnered, otherwise it may create a asset liability mismatch issue because short term fund cannot be utilized for long term utilization. It will not only impact your current ratios, it will also affect your balance sheet management as a whole, your fund management as a whole, which may create a negative impact on the going concern assumption of that particular company. So nature of instrument is the ICDs are direct, means one to one, corporate to corporate transactions. They are unsecured loans. When you talk about a deposit, it's more of a loan only. These are not securities. They are not traded. They are not traded instrument like bonds or stock markets. So that's how they are differentiated. Purpose is, as we have already discussed, to direct flow of fund from one corporation to another corporation or company rather than to create a security that can be bought and sold in the secondary market. Market structure of ICD is that it's a direct market instrument where companies with surplus fund lend to companies in need. Now, one of the important aspect that is the pricing, whether ICDs can be issued at a 0% rate of interest. No, ICDs cannot be issued at 0% or say 1% rate of interest. There is a mechanism that we will discuss in Section 186 of Companies Act, which is a later part of this PPT. But generally what it is done, it is generally high rate of interest is charged because it's unsecured in nature, so there is an inherent risk that there may be default, there may be counterparty risk, so higher rate of interest is charged even though it is between the related party or say between a holding or a subsidiary company. For that also pricing will be governed by provisions of Section 186. For the unrelated parties, yeah, of course, the transactions are done at arm's length, or even though it is a related party, then we will see the provisions of Section 186 regarding the pricing. Then it will be more clear to you. Range generally 1 day to 1 year, that is the range of ICDs, and common tenure, if you see the short term tenure, that is of 90 days. If you see the credit rating of one of the intercorporate deposit, generally you will find that they are issued for 7 days to 365 days. So this is generally you will find if ICD is rated, then you will find it. What are the determinants? The specific tenure is offered determined by the credit rating of the borrower company and the terms offered by the lender. It's short-term nature, it's unsecured short-term loan. The tenure reflects the short-term financing need of the corporation with surplus or deficit fund. Can ICDs be rated? As I explained in the previous slide, yes, they can be rated. If you go through the ICRA website and you see the credit rating of this particular company, you will see that their ICDs are rated. Recently in March 25, this rating was given for this company. So yes, they are rated. Now, what are the RBI regulations related to ICDs? No, RBI regulations are very much specific to NBFCs or primary dealers. They are not applicable for all the corporates because they are not the regulated entities. So for the regulated entities, RBI has some norms or regulations. Like for NBFCs, activities not eligible for bank credit means once a bank gives loan to NBFC for on lending purpose, then if the NBFC is giving on lending, say for unsecured loan or intercorporate deposits, then that bank cannot lend to NBFC. Hope that point is clear. For example, a bank is giving loan to an NBFC, and NBFC is giving that particular loan, that particular fund arranged from a bank, and again disbursing some unsecured loan or giving ICDs, so that is not allowed as such. So NBFCs are in this business, then banks cannot lend to NBFC. That will be an ineligible bank credit. So that is the first thing. Second, public funds include ICDs. So the regulations of NBFC is based on their public funds, their interaction with the customer. So the public fund, in the definition of public funds, NCDs has ICDs have been included. For primary dealers who are the market makers for the government security market, they can raise funds by accepting ICDs. Means they can issue ICD or they can arrange funds by making this one-to-one arrangement and then can garner funds. But they are prohibited from placing funds in ICD market. Means they cannot lend or they cannot give funds under the ICD mechanism. They can only accept it. So these are the RBI regulations with specific reference to NBFCs and PDs only, not all the corporates. Now, one very important point is, since there is no very specific guidelines related to ICD as such, except the provisions of section 186 which we are going to read now, but prior to that we need to note that documentation is very important because it's a one-to-one transaction between two corporates, so that this part should not be missed. Because recently NCLT bench of New Delhi, Chief Justice retired Ramlingam Sudhakar, President, and Avinash K. Srivastava, technical member, has held that mere recording of the transaction as intercorporate deposit in the balance sheet is insufficient to establish it as a financial debt without supporting documentation. So that there should be documentation. Documentation should clearly define the tenure, the usage of fund, all the critical legal points should be there in the all the important covenants should also be there. Then only it will be regarded as a financial debt, and you will be, or the lender will be considered as a financial creditor while going through the settlement through NCLT. So hope this point is clear. So you can revise whatever we have studied right now. So they are more exposed to credit risk or counterparty risk because they are unsecured in nature. They are alternate to corporate bond or say bank credit. And what are other various money market instruments that also you can go through. Now coming to the most important section 186 of the Companies Act, the heading of which is loans and investment by a company. So one thing I need to clear it out, that intercorporate deposit, whatever we have studied till now, it's more of a money market instrument, like 1 day to 1 year, that has been defined, or that has been a market practice for ICD to be considered as an ICD. But with reference to section 186, what it says, that an ICD or ICD word actually has not been used here in section 186. They have generally used the word loans and advances by a company. So we will be discussing from that particular aspect. Means it may be for a tenure more than 1 year also. So we'll also discuss about the pricing issue, the tenure thing. The tenure may be higher. It is not restricted up to 1 year. So market practice may be different. It may be up to 1 year only, but the Companies Act is silent on that aspect. Companies Act, it's saying that tenure may be of higher maturity also. So subsection 1, that is the most important section. And thereafter we'll discuss about the main section, that is section 2, subsection 2. So 186 subsection 1 says, without prejudice to the provisions contained in the Act, a company shall, unless otherwise prescribed, make investment through not more than 2 years of investment companies. When a company gives loan to another company, and that company gives to the second company, then third company. So this complex web is created. Then you are not able to find out where this transaction originated. So this complex web of fund arrangement is established. To avoid that, this provisions has been introduced in the Companies Act, that it should not be more than two layers of investment company. So what is an investment company, what are the practical aspect of it? I will explain it through a particular example, but let's first discuss this section. Provided that the provision of section shall not affect a company from acquiring any other company incorporated in country outside India, if such other company has investment subsidiaries beyond two layers as per the law of that country, or a subsidiary company from having any investment subsidiary for the purpose of meeting requirement under any law or under any rule or regulation framed under any law from the time beginning. I mean, if otherwise provided by the law, it cannot be done. If the law of a particular country allows that, or that particular law is allowing this to happen, then it can be acceptable. Now the most important section, that is subsection 2. The company shall directly or indirectly, no company shall do it, that to give loan to any other person or body corporate, give any guarantee or provide security in connection with the loan to any body corporate or person, or acquire by way of subscription, purchase, or otherwise the security of any body corporate. Means no company shall give loans and advances to another company, or guarantee to another company, or say acquire or purchase by subscription or otherwise the security or means equity shares of other company. So here it's not only we are talking about the intercorporate deposits, because the intercorporate deposit, that word is used in the market as such. The companies that talks about the loans and advances, guarantees or investments exceeding 60% of its paid up share capital or free reserves and security premium account, or 100% of the free reserves and security premium amount, whichever is higher. So means that much can be done by a company, that much loans and advance can be made by that company, or equity investment can be made by a company in another company, if it is not more than 60% of the equity share capital or plus free reserve and security premium, or 100% of free reserve security, whichever is higher. So explanation says that the person doesn't include any individual who is in the employment of company. Means a company gives loan to its employees, then the provision of this subsection 2 shall not be applicable. Now what if it is exceeding 60%? In that case special resolution will be required. Board resolution is required, and special resolution will also be required in case this is exceeding the 60% or 100%, whichever is higher. So that explanation is also there, that you need to note. No loan can be given under this section at a rate of interest. Now I told about the pricing aspects, so here comes the subsection 7, which talks about the pricing at a rate of interest lower than the prevailing yield of 1 year, 3 year, 5 year or 10 year GSEC closest to the tenure of the loan. Say I gave a loan to a company for a tenure of say 9 years, and prevailing GSEC yield uh, is that of 10 years, which is say 6.5%, then I will charge at least that much rate of interest. So the point is, it cannot be given at a 0% rate of interest or a lower rate of interest. It should be at least that, it should at least that yield. So if the related party transaction is there, that aspect needs to be taken care. In the market transactions or arm length transactions, of course, as per the risk perceiveness of the company, the spread will also be charged. Say 6.5%, say risk premium, say 2%, because they are unsecured, and tenure is also high, so say 1% more is added. So they say 9.5% will be the market rate of interest for such loans if it's at arm's length. Section 11 further says that nothing contained in this section except subsection 1, that is the investment beyond two layers of investment company, shall apply to any loan made or guarantee given or security provided or any investment made by a banking company or insurance company or a housing finance company in the ordinary course of business, or a company established with the object to engage in the business of financing industrial enterprise or providing infrastructure facilities. Means the provision of this section shall not be applicable to these HFCs or banking companies or insurance company, except that subsection 1 means that layer investments. So let's discuss what is an investment company and what we consider by that two layer of investment thing. So as per explanation of section 186, investment company is a company whose principal business is the acquisition of shares or debentures or other securities. Means whose main business is only to invest in other securities or debentures. Maybe it's equity or debenture or other security. So whose principal business is that only, that will be considered as an investment company. So suppose there is a company Y, that is an operating company, will consider there is an investment company, or a company which is not an investment company will consider that as an operating company. So suppose company Y is an operating company, means whose principal business is not to acquire shares or equity of other company. So company Y makes investment in company A, which is an investment company. So this is the layer first. Now company A further makes investment in company A2, which is an operating company, means this is the first layer as of now. This is not the second layer because it is an operating company, it's not an investment company. Now company A2 invests in company A211, which is the operating company, it is allowed. So company A2 further, so invested in A21 investment company, this is the second layer. So this second layer is investing in operating company, that is allowed. Now two layers are there of investing companies, investment companies, and this will be the third layer. So this will not be allowed because this will be the third layer. Similarly, this the company is the first layer. Now it is investing in A1, that is the second layer. So yes, this is the second layer. So company A1 is operating company, yes, allowed. This is not allowed because this will be the third layer. So this is how you need to understand that thing, because the complex web of financial transactions, when these things are happening, then it is very much not be possible to trace where this transaction originated or event concluded. So that's why this particular provision has been introduced in the Companies Act 2013. So overall analysis, if we consider that the complex web of fund movement is there, so that is addressed to some extent by section 186. Subsection 1 is there. Then pricing aspect is also covered in section 186 subsection 7, that talks about the maturity of your intercorporate deposits or loans and advance. So intercorporate deposit word has not been used, but that is included in it. So loans and advance should not be below the yield, that and the maturity should be matching. Say a GSEC yield of 1 year, 3 year, 7 year, 10 years is there, or 5 year is also there. So the tenure of GSEC yield, and it should match with the tenure of the loans and advances. So the interest on that much loans and advances should not be lower than the yield of GSEC. Then documentation is very important. Otherwise, your this intercorporate deposit, that may not be considered as a financial debt. For that, we have referred to one NCLT judgment. And unsecured loan and cash equity, this is a very important point again. So while assessing a balance sheet, we sometimes what we consider as the unsecured loan given by a company, we consider it as cash equity. So generally, for a group concern, say holding companies giving unsecured loans to subsidiaries, so that may be considered a cash equity. But for that, you need to see the pricing, you need to see the relationship between those companies, you need to see the tenure of that loan also. And what is the quantum, means it should not be that substantial that once this fund is withdrawn by the holding company, the net worth is severely affected. So pricing, their relations, the tenure, and the quantum of that unsecured loan, you need to consider those much things to further analyze the balance sheet. While appraising a project, or say for any other usage, you need to know that when it can be considered as an cash equity. So hello all, today we will discuss about intercorporate deposits, various rules and regulations governing it, provisions of section 186.